buy a website, get paid every month, forever. That was the contract, and it was signed. Kenneth Courtright ran a company in Minooka, Illinois, called the Income Store. It sold websites that earned advertising money. More than 500 people signed up. Retirees, small business owners, people who wanted one bill covered every month. A judge later ordered him to repay $68.7 million to the people who signed up. Here's how it actually worked. The monthly payments weren't coming from the websites. They came from the next customer's check. The deal had a name, a consulting performance agreement. Buyers were called site partners. You paid up front. The company built your sites. You took a cut. Your fee could only be spent on your own websites. Buying them, hosting them, marketing them, nothing else, ever. The website was yours. Sole property, said the contract, and the payment ran into perpetuity. Forever, in legal clothing. If the websites did well, you took half the advertising money they earned. That was the upside, on paper. If they did badly, you still got your 15% a year, paid out monthly. The floor didn't move, so the promise was fixed. The income wasn't. The same contract swore the company was solvent and paying its bills. Between 2015 and 2019, the websites and the business loans together brought in about $27.8 million. The payments he'd guaranteed over that same stretch came to $49.3 million. That bill came monthly. The money he owed was nearly double what the business earned. Every month, that gap had to be filled. It was filled with upfront fees from new customers, $132.6 million of them. The company's own controller said so. The company's own accountant said so. And so did an FBI forensic accountant. All three told the jury the same thing. Without new site partners signing, the obligations could not be met. A bank loan officer testified Courtright told him directly. When ad revenue fell short, new customer money covered costs. The staff grew past 100 people. There was a second office out in Lancaster, Pennsylvania. From outside, it worked. Then the traffic turned. By his own testimony, the company's revenue fell substantially between 2017 and 2019. The guarantee didn't, so he borrowed from a private individual and from lenders charging interest as high as 200%. He also moved $2.9 million out of the company's accounts and into his own personal bank accounts. $975,000 of the company's money went on his own mortgage and on tuition for loved ones. This isn't a yachts and supercars story. It's a mortgage and school fees, paid for with other people's website money. In December 2019, the letter went out. It mentioned challenges and headwinds. It asked site partners to accept a 4-month pause on the payments guaranteed forever. What it didn't mention was where the payments had been coming from, or that the trouble was years old. The appeals court noted the letter never mentioned the use of upfront fees or its long-standing financial problems. That same month, the federal market regulator sued. A judge froze the assets and put a court-appointed outsider in charge. That February, agents arrested him and charged him with wire fraud. He was released on bond the same day. 3 years later, the case went to a jury. In July 2023, after a 2-week trial, a jury convicted him on all 7 counts of wire fraud. Prosecutors called it a Ponzi scheme. That's a description, not the charge. What he was convicted of is wire fraud, lying for money across state lines. At sentencing, the government offered 4 different ways to measure the loss. The judge took one, then cut it down. He allowed credit for money already returned to investors. He refused to credit the cost of running the operation. Crediting that, said the court, is like crediting an armed bank robber for his gun, bullets, mask, and getaway car. The court settled on a loss figure of $52.5 million, below what prosecutors had asked for. The sentencing rules called for at least 17.5 years. He got 90 months, 7.5. The repayment order came to $68.7 million. The court waived his prison costs, finding he couldn't pay. It recommended a prison camp where he could work and pay some of it back. He never got that camp. He's serving those 90 months at a low-security federal prison in Yazoo City, Mississippi. Release date, September 2029. In 2021, around 3,300 income store websites were reportedly auctioned off to recover money for investors. $132.6 million came in as upfront fees. That was the money in. $68.7 million is what a court ordered paid back to them. That's the money out. The sites are sold. The receivership is still open. And the payment that ran into perpetuity lasted just 5 years.